pleasure of speaking with two well-known veteran fraud fighters, Ben Wallach, co-founder and managing partner of Mission Omega, and Frank McKenna, co-founder and chief fraud strategist of Point Predictive and author of the very popular industry blog, Frank on Fraud. Thank you both for your time.
Thanks for inviting me to speak with my good friend Ben on auto.
Yeah, it's great. It's been too long.
Yeah, getting the band back together. Awesome. Well, let's jump right into today's topic, which is all about fraud in the auto lending industry. The first quarter of 23 has been quite the roller coaster ride in the financial markets. There's a lot of uncertainty in the air. You know, people and businesses are feeling the pain of high inflation, high interest rates, you know, lots of layoffs in the tech sector and others, and ongoing, you know, geopolitical conflicts. And we're now starting to see reports that, you know, more Americans are starting to fall behind on their car payments. Then I saw last month Bloomberg reported that the subprime auto lender American Car Center suddenly closed for business, which was allegedly a total shock and surprise to their employees and customers. Not sure if you guys saw that. So what's going on? Some folks are starting to say that, you know, the next banking crisis is going to heavily impact auto loans and lending. And so, you know, I'd love to get your perspectives on what you're seeing, what things could start to potentially look like, and of course, you know, what that means to all of our fellow fraud fighters out there. So, Frank, I'll start with you. I read something recently where auto lending fraud increases pretty significantly during times of inflation and recession. So do you have any insights into, you know, where the auto lending industry is heading in terms of risk this year?
Question. So we did a survey earlier this year to about 40 auto lenders, so senior executives, and tried to get their pulse on what was going to happen in 2023, because this was in January. We wanted to kind of understand what they felt about risk and fraud this year. And 75%, you know, nearly 3/4 of them felt that fraud was going to be much worse this year due to the economic situation that we're in. And if you think about it fundamentally, what's happened in auto is that interest rates started to rise. At the same time the interest rates are rising, you had a shortage of used cars, and the prices of used cars and new cars started to go up a lot. So at the end of the day, it became much more expensive. So the same car, maybe 20%, 25% more expensive, but people's salaries haven't increased by that much. So what you see is this kind of gap between what people can afford and what people make. And so the only way to get those cars oftentimes is to misrepresent your income or employment so that you look like you can afford that car. And unfortunately, that's what's happening. So I think this year, with the inflation, with the, you know, pressure on prices, with the interest rates, that we're just going to see, and I think the executives at these auto lenders feel the same way, there's going to be a lot more what we call first-party fraud, where consumers or even the dealerships on behalf of the consumers are misrepresenting their information. That's the environment that we're in. So for fraud fighters, it just means we're going to have to double down and just be much more alert to these types of patterns and trends.
Yeah, I agree with Frank on that one as well. Just to add a little bit, I think it goes back, some of it, to the pandemic, and some of the PPP loan money went into down payments on fairly expensive cars. And now we're in a little bit of a tighter crunch, like Frank alluded to, and it's easy to let a card, you know, go back. The delinquencies are rising now. They're at a high, I think, you know, for like 17-year high, something like that. And I think the dollar amounts may even be higher than the home loans that were going into default before the great financial crisis. So this could be a pretty big event from an economic perspective. And anytime you have something like that, it's going to impact fraud. There's going to be the first party fraudsters that are going to take advantage of that. And there's also going to be some customers that are on the books that have been customers, could be dealerships, that all of a sudden have to turn to fraud or feel like they have to turn to fraud to keep their revenue up.
That's a good point, Ben. I think that you brought up the COVID fallout and the stimulus fallout in the auto industry. And we had an interesting research that we did because we wanted to say, where did those fraudsters go after the stimulus funds dried up? They were, by an estimation and other experts, there was up to 1 million new people learned how to commit fraud during the pandemic because of all this government money that was out there. And they learned how to commit sophisticated frauds like identity theft, how to create synthetic identities. And when those stimulus funds dried up, where do they go? Do they just go back to their day jobs? And what we found was some interesting things in auto in particular. We looked at about 300 confirmed synthetic identities that happened at auto lenders in, I think it was last year, 2022. And we did a research on those 300 synthetics. And we were able to find about 78% of those synthetic identities that had purchased a car in 2022 fraudulently. They actually had gotten a COVID PPP loan the year before. So we saw clear evidence that COVID had a real impact on a longstanding impact on auto lending fraud that we're still seeing today.
And that also drove the prices up because there was a supply chain issue. So a lot of this stuff is going to be, connected to what we're going to probably talk about in a few minutes, as well as where we're at today. But that drove the price of automobiles through the roof as well. And now, so we're about to deal with the fallout of that as well. Great points.
Yeah, for sure. And Ben, I guess, from your perspective, you've been a fraud executive at several large banks. How should financial institutions be looking at and preparing for the situation unfolding as it relates to, the rise in potential auto loan defaults?
I think I'd look at it probably in two components. One is new fraud that's going to come to their door. And that's where I think you really want to, work with like a Frank McKenna and his company to look at the data that they've got on what are these new fraud trends saying, what are these new attack and threat vectors looking like, and how do you want to adapt your controls for those. But then you also want to look in your portfolio that you already have, because anytime there's an economic downturn, you're going to have customers that are long-standing, legit, good customers on the books that are going to, turn to fraud, whether it's, a dealer floor plan or whatever the case may be. We saw this a lot with the builders back in the great financial crisis, had accounts at all the banks. They were completely set up to commit fraud. And when the housing crisis hit, a lot of home builders turned to kiting and committing other forms of fraud. So could have been on the books for 10 years and looked like great clients. So going back and looking at your risk assessments of particular clients, in this case, car dealerships, auto lender, those kind of things that could turn bad overnight because they feel like they need to keep a level of revenue churning, but there's nobody buying their cars, or they're underwater in their floor plan, or whatever the case may be. So I'd look at it as, how do I treat existing customers and how do I treat new customers, and make sure that you're looking at that from both angles, but having the program behind it, having the data and insights that Frank has. I think those are going to be very important.
Yeah, I think that, Ben, you're absolutely right. I think the one big gap I see with a lot of auto lenders is reporting, especially around fraud. Like, you'll be surprised at how many lenders when we interact with them and say, what is your fraud? What was your fraud last year? And there are quite a few that just don't know. They just don't track it. They don't report it. And Ben, if you don't track or report something, it doesn't really ever get investment. And I think, to your point, that tracking, even internally, is just phase one, right? Of how do you really respond to it? You got to be able to report it.
Yeah. Having a taxonomy, so everybody in the company speaks the right language, knowing what your fraud risk and threats are, knowing what your controls against those things are, what your residual risk after those controls are. so that you can set the right, risk environment for that. And having that blocking and tackling is going to allow you to create the kind of reporting that Frank's talking about, so that you know what you're looking at. Because one of the things that a lot of institutions don't have, but they need, is what's my attack rate? Because a lot of companies that do have reporting only look at the fraud that gets through, so they don't even know how much is knocking at their front door. Because there's one thing I can guarantee you is if you have an attack rate of 100 today and 200 tomorrow and 300 the next day, there's something there. They may not have gotten through yet, but they are going to get through, and they feel like there's something legitimate there for them, because they run a business and they don't, put their attention to something they don't feel like they can have a return on investment on.
Mm-hmm. Great.
Yeah. So you mentioned taxonomy, and everyone, being aligned on definitions and what that means. So I guess, Frank, question for both of you really, but I'll start with you, Frank. When you look at taxonomy and fraud types, what kind of fraud and scams are typical in an environment like this, in auto lending? And so what should financial services organizations be looking for?
Look for credit repair fraud. So what happens when borrowers are really stretched and they're trying to get a car is they go online and they're on Instagram or Facebook and they see somebody offering to help them get a car with no money down, use we call a CPN, and CPN means credit privacy number. It's a code word by credit repair companies to sell you a stolen social security number so you can create a new credit profile so that you look like you're a better credit risk. All this credit repair is going to be really big this year, especially now because a lot of people are getting tax return money back, but maybe their credit isn't so good. So these credit repair companies will help them fraudulently repair their credit or create a new credit identity with that tax return. So it's very active right now, and it's very active whenever there's a recession or inflationary environment. So look for credit repair fraud, and that incorporates synthetic identities. It includes people using falsified pay stubs that they bought from these credit repair companies. It includes using fake employers. Basically, and these are employers that the borrower will buy, for $200 or $300. And when the lender or the dealer calls the employment number to verify employment, there'll be a person on the other end of the line that'll answer and say, yes, they're employed here. And yes, they make that amount of money. That person may be completely unemployed and never made, a dime, but they'll say that they make $200,000 or $300,000 a year. So look for that, fake pay stubs, falsified incomes, all of that is kind of part and parcel with these credit repair companies that are basically trying to deceive lenders and dealers. So that's what I think lenders need to be on the alert for this year, in particular.
Yeah, that's great. And one thing I would add to that is, looking at the dealers, for dealers that are going bad, I would look out for that. Maybe, take a look at how you risk assess your portfolios. If you've got a dealer that's dealing in autos at the lower end of the spectrum, it's going to take a little bit longer for the downturn to hit them. If you've got a dealer that's on the upper end of the spectrum, they're going to get hit first. And so you may want to, reassess risk there. You may want to increase, some site visits to make sure that the cars are on the lots and, things like that. So reassessing your portfolio, I think, is important as well. So there's that consumer side Frank talked about, but there's also that commercial side to look out for. The higher volumes, obviously what Frank's talking about, but one event on the other end of the spectrum could be pretty costly as well. So I'd say if you look at both those things, you're going to cover the bookends.
Yeah, and I think, Ben, you brought a good point, the dealer fraud, which I think you're absolutely right. I think what's happening with dealers right now is they're getting hit with a lot of identity theft too. We're talking to some dealers that 1 in every 3 person that are entering the dealership to buy a car is using stolen identities. These are certain parts of the country. So there's just a rash of identity theft that's hitting these dealers. So the dealer may not be involved in this fraud, but they're being targeted themselves because they've had loose maybe fraud controls in the past. So they're not intentionally committing fraud. So lenders do need to look at those pockets of risk at the dealer, because sometimes you need to notify the dealer, hey, you're actually being targeted by fraud. So I think the dealer aspect monitoring is so important this year.
Absolutely. That's a great point.
That's an excellent point. Well, and Ben, you had mentioned the great financial crisis, and there's been a lot of chatter online that I've been noticing where people are comparing this, auto loan default meltdown to the mortgage industry during the great financial crisis. And many folks would rather lose their home than or would rather lose their car than their home. So taking a loss on a vehicle is more likely than a home for many people. So there's a perceived lower risk on the consumer side, but would love to kind of hear your perspective on, where does the risk lie with the banks, and really would it impact a certain asset size bank over another, such as community banks or credit unions, since they're such staples in communities and do a lot of that, like personal lending, in relationship driven lending in their markets.
I think volume wise, it's very comparable to the GFC from a home and auto perspective. I think it's very comparable from a volume perspective. I think one key differentiator is what you said, that if it's your third or fourth car, it's easy to let that go back, easier than it is the roof over your head for your family. So that's one key differentiator. The other is as these cars are repossessed and the banks run them through the auto auctions, what's happening right now is they're not getting the prices they would have gotten months ago. So they're holding them over thinking, I should get a better price for that. So today they run one through the auto auction. Tomorrow it's two. The next day it's three. And there's going to be a cliff most likely that we drive off, where all of a sudden they've got to clear the books of those, and the value could drop significantly overnight to get those defaults off their books. So that cliff is, if and when it happens, is going to impact the entire auto industry. And when that does, that's definitely going to open the doors for more fraud, and especially your good clients turning to fraud, unfortunately.
What's interesting, I think, about this time around, I think in 2009, what was happening is people had paid way too much for their home, and they started to what they call strategically default, where people figured out, because home prices were plummeting so quickly and they'd overpaid, that they could basically walk away from their mortgage and then rebuy a home, the same home potentially for $500,000 less or $600,000 less, and make money. They called it strategic default because it was kind of smart, right? It was like let the home go and buy it back, buy another home that's even better for less. What's happening in auto is there's some of that happening now too. What you see is people last year had overpaid for their cars. Those car values are not coming way down, and they're really underwater. So their current loan is actually more than the car's worth. So what's happening is people are actually going into dealerships to buy a new car that's a better car, knowing that they're not going to pay the car that they have. And lenders, because they're trying to keep their volumes up, are removing the stipulation that you have to sell the other car to get this new loan, knowing that their borrower is probably not going to pay it and it's going to default anyway. So it's almost like they're letting borrowers swap out and creating more defaults by defaulting on those cars because they're going to get repoed. But the borrowers don't care because they have a new car. So it's almost like strategic defaulting that we saw in mortgage about 10 years ago now. So some of that is happening right now in the market, and it's making default rates go up. So it's kind of the same old thing. History always repeats itself.
Yeah, it's this cyclical thing too, where you're letting go of that vehicle, you're defaulting, then your credit takes a hit, then then comes swooping in the credit repair fraudsters. I mean, it's just all this cycle.
It's very cyclical.
Yeah. So I guess a question to either of you, there's a lot of discussion about regional banks right now. The Wall Street Journal last Friday said that 186 regional banks in the U.S. are in trouble. And if that's true, it's going to be more difficult for these financial institutions to stand alone. And, we could see consolidation, mergers and acquisitions. And so, since there are a lot of folks in local banking that are giving credit based on these personal relationships and community ties, kind of going back to how everything's connected. I'm curious to know what you both think on, what a credit squeeze and more formulaic lending from larger FIs could mean for consumers, and the impact of fraud. Like, are they going to be falsifying, more employment stats? What does that look like if lending standards begin to look different in local and community regional areas, really?
Well, so when you have this type of situation, you start to tighten credit. So who suffers the most when you have a kind of credit squeeze? It's the subprime borrowers. It's the young borrowers who don't have established credit. It's the people that, are maybe don't have stable jobs. Those people are the ones that essentially get squeezed. The super prime and the prime borrowers, there's always going to be, money for them to finance cars. So you're really going to see those borrowers kind of left without options. When they're left without options, they're going to turn to these credit repair companies. I go back to it because it's going to be inherent in what people are going to see. First thing they're going to do is wash the credit, right? If you have a 500 FICO score and you need to get a car, there's a lot of credit repair companies that will go out there and systematically do identity theft claims with all of your prior credit cards and auto loans that you defaulted on and get them removed from your credit. That's fraud. That's actually fraud, but it can boost somebody's credit score from a 500 to a 750. Now they're not squeezed out anymore, right? They now have an option to get a car. All of those types of shenanigans are going to happen this year when you tighten the credit. I think on the positive side, credit unions are going to get a lot more volume. I think they already started to last year and this year, as you start to see some of the subprime lenders tighten and maybe the big banks tighten. Credit unions are picking up a lot of that extra opportunity. So while those borrowers might be squeezed out of community banks and some of the regional banks, there might be some opportunities with credit unions and others that might be more willing. So there's always, things are always going to shift around.
Yeah, I agree 100% with Frank. I think the volume that we're seeing in scams across all different, industries and types of fraud and everything like that, I think it's going to play in here as well. People that are in a tight, they're going to get scammed into pay for this service, do this. They'll think it's legitimate and they'll go through the process. So I think, the scams will go up for that. But then I think the actual fraudsters will just increase what they spend on their credit process so that they can, if a bank increases their requirements from 700 to 750 or 750 to 800, then they'll up the ante, spend a little bit more and stay in the game. So I do think that's going to happen more and more. And just being vigilant and watching for those things and us as an industry getting better and better at picking up on scams and things like that, and just helping the clients that don't understand what they're getting into, helping them discern exactly what's going on is going to be critical, not just in the auto lending space, but across the entire paradigm. That's going to become more and more important because, going back to the pandemic, the street gangs had to be off the streets. So they all turned to fraud and they haven't left it. They enjoy it, They can now work from home. They don't have to get out on the streets. So the number of fraudsters that we're up against, went up. The volumes went up. pig butchering. We don't have time to get into that, but that's something if the viewers are not aware of to go research, because that drove the volume up. So the entire pie is growing, and the piece of this pie is going to grow. So it's going to be exponential.
Great. Well, so much great information shared today. Any final advice for our fraud fighters out there during this really bizarre time right now in the financial markets?
Yeah, I guess I'd have a few things. I mean, the first thing I'd say is look at your early payment defaults. If you're an auto lender and you're worried about the shift in fraud, the first thing to do is look at those loans that are not paying right away. Also, look at the loans that are kind of defaulting. Ben, to your point, look at your existing portfolios and look at who's not paying. Sometimes the clues of what you need to do are going to be in those reviews that you do. We call it kind of like a post-mortem. I would be doing those this year on a monthly basis with your key losses. Secondly, I'd be tracking and reporting on fraud if you're not already, because that's going to tell you where you're trending and how you can respond. And the third thing I say is this is not the time to, I know when you go into a tightening environment, the first thing is let's cut back on staff, let's cut back on investment. But I can tell you the one place you don't want to cut back on this year is in your fraud staffing and your fraud investment in technology, and all of those things you really want to stay really focused on, because if you're the weakest link in the chain, the fraudsters will attack your portfolio. So you want to have a good defense.
Yeah, I think I would start, where Frank ended. I would pick up there just to say it's so critical to make sure you're investing based off your risk posture and exposure and all those things, that you're investing in this space right now, because as we enter economic downturns, the number of profitable clients entering the each company is less. The number of fraudsters and the risk that they pose increases exponentially. So investing in this space is critical for the people that hold the purse strings, for the people that are in the mix, getting the dirt under their fingernails and fighting the good fight every day. I'd say, you've chosen a great career. This is one that I haven't met a person yet that said, I used to be in the fraud space, right? Once someone gets in, they're in the vortex and they're sucked in because of all the purpose and passion around it. So it's a great career during a time like this, because there's going to be a bigger battlefield, more battlefronts, more fights to fight. So stay vigilant, stay positive, but definitely stay in the fight. And if you're at a place that's not investing and you're frustrated, go to somewhere that is investing, because there will be those companies that invest in their fraud fighters because they want to do what's right by their clients and by their investors. And so there are places like that. So don't get disheartened, stay vigilant, and know that you've chosen a great career. But there is a lot of opportunity coming up, and definitely need to stay vigilant. The final thing that I would say is there's a lot of things that collect dust over the good times when the printing presses are turned on, like kiting. Very little kiting when the printing press is running, but during economic downturns, those things shoot up, and those are your oldest, most outdated, most antiquated systems and processes, and they collect a lot of dust over the years. So I would go and take a little time and dust those kind of things off.
Excellent. All incredible advice. I know there's a ton of great resources out there for folks to continue their education. Frank, your blog, Frank on Fraud, is really great to stay up to date on what's happening. There's the ACFE, the Association of Certified Fraud Examiners site. There's a lot of great resources out there for folks to continue to stay in the know on what's happening in the space. And, if you are really passionate and you want to get involved in like a bigger, broader way, there are also nonprofit organizations like the Noble out there that folks can check out and see how they can get involved with some really heavy stuff like human trafficking. But my goodness, the difference that it makes. And there's some really cool case studies that folks can check out about how fraud was stopped during the Super Bowls, and just so many other cool things. So from my standpoint, I would also just encourage that continuing education, and hearing and learning from folks like you guys who've been in the industry for a while and have seen it all, and are continuing to stay on top of all the emerging threats. So thank you again for your time today, and looking forward to keeping in touch, and check, hopefully the auto lending situation doesn't have to be as doom and gloom as it seems like it could be. But to your guys' point, keep investing in your fraud teams and technology, and keep fighting the good fight.